what we want to do is we want to pick, actually it's quite nice. So we have a June series that expires in 25 days, and then we have a July series that expires in 60 days. So if you look at the June series, what we have there is the June series is showing an implied volatility of about 20%, and the July series is showing about 21.5%. So that kind of a volatility difference is normal. You will see the back months having a slightly higher volatility number, and that's kind of normal. Now, if you recall, our calendar, we are going to be selling the front month. So we're going to take advantage of the fact that the front month options are going to decay much faster than the back month. And the other aspect of a calendar is it's a Vega positive trade. So if volatility increases in gold, then our gold trade will be even more profitable. So you can make money from two sources in a calendar. You can make money from time decay, which is your primary source of income in the calendar trade. And the second way you can make money is if volatility increases, because it's a Vega positive trade. And in general, it's very hard to find a Theta positive and a Vega positive trade, but the calendar is one of them, and so that's what we'll do here. Let's go quickly take a look at, now we're going to be dealing with at the money options, because in general you want to put the calendar at the money. You don't want it to have any kind of bias. So let's put our in fact we don't even need 10, let's just put 5 strikes up. And gold is, rather the GLD ETF is trading right in between 154 and 155. So we could use either one as our strike price, the 154s or the 155s. We could use either one of these as our strike prices. And let's see, in the 154, we might have a little bit more option premium. So, but of course, now we're going to be selling the June. So we are selling this one, which has a mark price of $3.10, and we're going to be buying this option, which has a mark price of $4.97. Now the $3.10, that option, the June series option, is going to expire, is going to have a time decay which is much more than the July option. So let me put time decay here, let me put theta here, and you can see that the June series has a theta of 6 cents and the July series has a theta of 4 cents. Now you might think these are all very small numbers, but once you put a trade on, you can see that the time decay is going to show up in absolute dollars, and that's when you'll get a real idea of what this trade is. And the second thing you should notice, which should not be a surprise, is that the Vega of the June series is 0.16 and the Vega of the July series is 0.25, and that's normal because you're going to expect a higher Vega for the series that's a little bit out in time, because that series has more time, and therefore there's more of an opportunity for the stock to jump around, and therefore